Accounting Standard 3 Cash Flow Statements. So in this section, we will go through cash flow from activities. We will explain what is direct and indirect method of cash flow statements. And if time permits, we will just take a problem or case study on cash flow statements, which is a short illustration of what exactly it is. So accounting standard cash flow statements. Here we will go through classifications of cash flow statements, which is operating, investing, financing, and net cash flow. We'll also see the representation of cash flows in the balance sheet. So first it is accounting standards cash flow statements. The standard states that cash flow statements should report cash flow during a period of financial statements classified in terms of operating, investing, and financing activities. Operating, investing, and financing activities. Hence, the first requirement which should be done is to classify cash flow into three heads, namely operating activities, investing activities, and financing activities. Let us see what is each of them. Operating activities. So in this section, we see that the incoming cash flow is recorded as positive and outgoing cash flow is recorded as negative. We'll take a look at an illustration and then we'll see how it is represented. So here it is, there is a cash flow statement for company XYZ, and then there are cash flow from operations. So what we see is that in this section, we see that the incoming cash flow is recorded as positive and the outgoing cash flow is recorded as negative. So there are positive and negative figures. Cash receipt from customers is recorded as positive and cash paid is recorded as negative. So which is an outflow of cash or outgoing cash flow. When the outgoing cash flow is subtracted from incoming, we reach the net cash flow for activities that are operating activities. In this example, we see that the net cash flow is positive, which raises no concern for the business. Next is about investing activities. Investing beyond means is not normally recommended for a business, but in any case, investments are a better option for business, and any money invested in equipment is considered as a negative amount and normally will be enclosed by a bracket. So in this investing activities, we have cash receipt from sales, which is a positive value, and equipment cost, which is an expense, is recorded in a negative fashion. Next is financing activities. Financing activities, after investing in equipment, the company has some money left over to pay off debts. This is normally represented by numbers and is mostly enclosed in a bracket indicating negative amount. Net cash flow is the sum total of all amounts in all the sections mentioned above. So that is the net cash flow, and we've got some figures for that actually. So we may have added cash receipt from customers in operations with cash receipt from sales from investing, and then we might have deducted cash paid from operations, equipment costs from investing, and then notes payable or loan payment from financing, and then we reach a final figures of 15,000. So the standard also suggests a direct and indirect method of cash flow. In direct method, cash inflows and cash outflows are represented in proper figures and is a known amount and gets recorded properly in terms of cash receipts and payments. So everything is proper and it is recorded also in a proper way in terms of cash receipts and payments. In indirect method, actual cash flows need not be known. It is taken from net income figures from income statement and uses the balance sheet account increases and decreases to figure out implicitly cash inflows and outflows. Also, it's mentioned that the cash flow statement be disclosed in terms of cash and cash equivalents and presents a reconciliation in terms of cash flow amounts with equivalent items reported in the balance sheet. So now let us see what gets represented in the balance sheet. So cash flow statements as it is represented in balance sheet is under current items and are classified into cash and cash equivalents. Cash is made up of cash in hand and those deposits that are demand deposits in banks. Cash equivalents are subject to an insignificant risk of change in value and are short-term, high liquid investments that are readily convertible into a known amount of cash. So that is the first section in balance sheet of what we represent cash flow statements as cash and cash equivalents. The next one is trade current items. So instances or examples include bills receivable, stock, debtors, prepaid expenses, accrued income, bills payable, outstanding expenses, etc. And lastly, it is non-trade current items. So the examples are current liabilities for fixed assets, short terms advances received, short-term advances made, and current investments, which cannot be classified as cash equivalents.